Welcome to this video on candlestick chart trading. This one is probably the most controversial video that I have done to date. So hang on, fasten your seatbelt. Some of you are not going to like this. So first of all, I'm going to show you I do trade candlesticks, by the way, but I've got to give you a big warning here. I know they're very popular, and like I said, I do trade them myself, but let's face facts. The Japanese created these back in, about the 17th century, trading rice in their van down by the river. Sorry, little Chris Farley reference there. Okay, some of you will get that, some of you won't, but basically that's true. Japanese created this charting technical analysis technique when they were trading rice back in the 17th century. Now, listen, things have changed, my friends. Things have changed a lot since then. The markets are almost all electronic. By the way, I've been to the Tokyo Stock Exchange. It's like a library in there. It is so silent. There's no people. The only people that are in there are the ones that are just kind of watching and manning the computer systems. So even the Japanese have completely changed their trading. In fact, they're ahead of us. They modeled theirs after the NASDAQ instead of the New York Stock Exchange. So we've got dark pools today. We've got flash traders, high-frequency traders. We've got a logarithmic trading. Over half of the stocks, or at least the shares traded at the New York Stock Exchange every single day, are done by computers, not by human beings. So, can we really use a 17th century technique today? Well, the answer is yes and no. Yes and no. So, here's what I'm going to share with you today. Maybe we'll do a little series on this because it's a big topic. So, I do use candlesticks, but in a very limited way, and only with other powerful things. I do not use them in isolation. I do not use them by themselves. And in fact, most of the people who do specialize in teaching candlestick patterns will tell you not to use them in isolation, and they're 100% correct. So today, let's talk about engulfing patterns. Engulfing patterns have a market logic to them, and the only things that I will trade are things that have what I call a market logic. So here's an engulfing pattern, for example. And the engulfing pattern means simply that the second bar there, the red bar, completely engulfs the previous bar, the green bar. Now, there's a couple ways that you can define engulf. So the most conservative way and the best pattern, quote unquote, for the word best, is when the real body, that's the red part of that candle, engulfs the entire body of the previous one. In other words, this is the open, and that's the close. That's the red part of it. And then at the very top, we have what's called the wicks, or the shadows. That's the high, and that's the low of the bar. So the best patterns are the ones where the red part between the open and the close completely engulfs the bar before it, meaning it engulfs the high to the low of the bar. And this one does, and this one does. So that is the most conservative approach to an engulfing bar. Now, I do not personally require that it does that, because let me tell you, you're not going to find that very often. It doesn't exist very often. In fact, if you're, this is a daily chart, so you'll see them a little more on daily charts, but if you're an intraday trader, you don't see them very often except right at the open because of the massive volatility at the open. So I don't require that. Let me show you what I look for. So what I look for is simply a pattern like this right here, where the real body of the green bar engulfs the real body of the red bar. So you notice the high of the green bar is not above the high, and not even the close of the green bar is above the high of the bar before it. They're both lower, and that's okay to me. What I'm looking for is the dominant value that the market found during that period of time, which is between the open and the close. The high and the low, those are the extremes, that the market actually rejected those values, and it's actually found most of the value within the open and the close. And so that's what I'm looking for, and you will find these patterns much more frequently, so that's another benefit. All right, so that's number one. You look for the engulfing, but now there's one more thing we need to look for, so let's go to that. So the next issue here is, let's look at these two bars right here. Now, the real body of the red bar is engulfing the real body of the green bar, but look how long the wick or the shadow is on the bottom. This is a bearish bar, and yet it did not close near the low. It actually closed pretty close to the 50% range, a little below that. But what that means is that, yes, even though the real body of that bar engulfed the real body of the previous bar, the close of the bar was not near the low. I want to see it in the bottom 20% of that bar, of the range of that bar. Otherwise, it's not a strong bearish bar, and therefore I do not count it. So that is the second issue. Now let's go on and look at a third issue that you must consider. Okay, so here's the third issue, and we'll look at these two bars here. And you'll notice how, my drawing isn't very good there, let me redraw that. But you notice how the green bar is really long, real wide range from low to high. Now, first of all, it is closing near the high, so that's good, within the top 20% of the range of the bar. The real body engulfs the previous bar's real body. But the range of the bar is very important. You see, so for example, we get other bars that are engulfing. Well, here's one here. We could even talk about this. But that's not a great signal. Why? Because those two bars are very narrow range bars compared to the rest. So when we talk about narrow range or wide range, we're talking about relative to previous bars. I want to see that range be at least 20% greater than the average of the last 20 bars on the chart. That's one way of measuring it. You can use other standards if you want to, but that's one that I do. The reason is because if you just get little narrow range bars, I mean, here's another example, okay, right up there. We get an engulfing bearish pattern, but look how narrow range they are. So whenever you get narrow range bars, that just implies neutrality. There's not strength in one direction or another, as opposed to here, we've got another engulfing pattern. But see, it made a higher high after that. But then after this, the dominant energy is very strong to the downside. It's a wider range bar, and the market does continue to go down. So look at the range of the bars. Now, number 4, I'm going to give you 2 bonus ones as well. So number 4 is that you want the entry or this pattern to come at the beginning of a new trend or coming out of consolidation. So in other words, if I got a bullish pattern, a bullish engulfing pattern up here, I wouldn't be too interested. But see here, we've been coming down, and to get a new impulse move up, yes, that's what I want. And that just goes with the principle of the trend is your friend until the end. So I don't want to trade a bullish pattern and in an extended bullish trend. I want to catch these patterns early in either a consolidation pattern or at the end of a bearish trend to the downside. So same thing here. We've had a basically kind of 1, 2, 3, 4, 5 swing pattern. That's not necessarily a wave pattern, just a swing pattern. And then we get a bearish pattern. So that's a little more interesting for me. Well, this video got a little longer than I thought, so we're going to do a part 2 to this, and on that one, I'm going to share with you some other things that you need before you can trade candlesticks. Absolutely critical. But if you like this video and you're watching it on YouTube, please click the thumbs up icon below, and especially I love it if you would share the video with others. I give you these videos for free, but you know what? Let's pay it forward. Pay it forward by simply sharing the video with others. Go to the social media icons down below and share it on Facebook, Twitter, or your social media of choice. And that really helps me to get encouraged to create more free tutorials for you. Also, hey, I've got one of my favorite trade strategies. I call the rubber band trade. I get emails from people on this all the time thanking me because they're making money with it, and I'm going to give it to you for free. You can learn it in about 26 short minutes. Get the video explaining that trade strategy by clicking on the image in the top left corner, or if you're on a mobile device, click on the little eye with a circle around it in the top right corner of this video. And if you're not watching it on YouTube, then that's cool. There's probably a link below the video or an opt-in form on the side. However you do it, once you ask for the video, I will personally email it to you.